I would say we can kick off. The panel has been introduced, so we go straight into the topics. Jeff, let's start with you. The last 2 years, in this conference, we kick off discussing about COVID as the major risk affecting our business. COVID is probably behind us, at least in terms of headlines. What are the major risks in front of us today? What keeps you up at night? What is your concern getting into 2023?
Yeah, listen, it's a great question. We are clearly entering a different phase here. I think there's a lot of students here, and they should learn from people who learned from the past. And we all learned from the past that spreads tend to tighten when rates go up. So that didn't happen, and we're completely caught off guard as we're entering into a refinancing wave. We also sort of grew up knowing that fixed rate borrowers would take advantage of generationally low interest rates and roll and get more tenor on their debt. Well, since 2007 and poor performance of long fixed rate debt borrowers, everybody's become a floating rate debt borrower. Everybody's private equity. Everybody wants less term and they want more proceeds out. And guess what? We just came off historically low rates. We're in a normal real estate world. If we were looking at the past, you wouldn't have the stress that you have today. But you have a tremendous amount of loans rolling in 2022 and 2023. And if you lost the roll lottery and you have a loan rolling between the middle of 22 and the middle of 23 into this higher base rate, higher spread, which we don't normally expect, which is because the Fed has sold mortgages, I think is the biggest reason why spreads are wider. There's a tremendous amount of distress. So you're going to roll out of a plus minus 3% floating rate mortgage into a plus minus 8.5% mortgage, and there's going to be a lot of stress in the system. So this is a very different year than COVID, where you had an opportunity to at least be nimble and take advantage of rates and do something. You're a little bit stuck with your maturity today.
So refi risk is main concern in 2023.
Refi risk is a tremendous
Jesse,
concern.
you agree or?
Yeah, I think there's no shortage of risks. I think, within our firm, the four we think about the most: rate volatility, inflation, geopolitical uncertainty, and now a recession coming. It's 4 risks is more than enough. Certainly there's more on an individual investment basis. We joke about it in the office. We're reminded about this joke comedian Jim Gaffigan tells, which is he describes what it's like to have 4 kids. And the way he describes it is, imagine you're drowning and someone throws you a baby. Yeah. So I only bring it up because it's a reasonable analogy of how we're seeing market participants behave today, and that people are struggling in 22 just with the first 3 risks, right? And rate volatility, inflation, geopolitical uncertainty, and now the Fed's going to throw a recession next year. And I think for the right reasons, it's causing a bit of kind of market paralysis. I think with those risks is going to come a lot of opportunity. I know from GIC's perspective, we've been pretty macro cautious for a while. The firm, from a top-down perspective, did a great job raising dry powder and de-risking in 21. But the thing about de-risking is you got to make 2 calls, right? You got to de-risk and then you got to re-risk. And so I think real estate teams, is certainly, it's an asset class, especially in the US, that the firm sees favorably. And, we have the luxury of being able to be tasked with re-risking. And, based on 22 and what we're going to see over the next couple of years, there's going to be a ton of great bottoms-up opportunities coming from all this.
Absolutely. So a bunch of different risks up there. Miriam, Jesse, touched base on rates volatility. 2022 is going to be, remember as a year where, rate vol, made our life miserable. Are you expecting the market will normalize when rates volatility reduces, or do we have, a credit crunch coming in front of us? And if so, how do you prepare for this?
Yeah, it's a great question. And so I think if you look at CMBS supply in the second half of the year, it's been incredibly depressed. And a lot of that has been because the CMBS market really led the way from a widening perspective this year. And so CMBS started to crack in January of last year to the extent that you had the ability to tap any other market. People really did. They put a lot of product into the bank market and elsewhere. And I think one thing that the CMBS market is still struggling from is a real buyer strike, where you have a lot of money managers who typically drive our market, who are very much on the sidelines until they start to see some macro stability and have a better sense of where the Fed is going to be. I think that said, we do think that CMBS has underperformed corporates. If you look at the firming that's happened in both the equity market and the corporate market over the last month or so, we think CMBS has lagged. And my personal view is that if you see some more stability in the macro market, you could see a lot more supply come into CMBS. We think particularly in the CLO market, if you see AAA is sort of sub 250, you'll see a lot of issuance there. And I think if money managers get a little more confidence that maybe the Fed is done by the second half of next year, you have a more normalized market and you could see supply pick up.
Gotcha.
I think CMBS is way too cheap, and we've had this massive credit curve steepening. And I look at it versus other things, but why is it cheap? I look at it and say the rest of the world is looking at property REITs and saying they're all trading at 60 or 70% of NAV. Real estate's in trouble. Real estate values are going down. And they don't really put in the piece that these are 10-year cash flows with a couple of times debt service coverage. And this isn't this cycle that I'm worried about these loans. So I think people are putting today's real estate market on 10-year maturities, and it's a mistake, and there's a lot of value to take out of CMBS.
Richard, question for you is, we've seen, rates volatility, we've seen spreads widening. One of the, positive aspects you would expect, looking at the past is in an inflationary environment, real estate tends to outperform other risk asset classes. Do you see this, inflation on or rents in particular offsetting this risk? And if not, what do you expect is going to be, implication for, investment volumes going forward in 2023 in particular?
Yeah, so I think there are some lessons that we can take from the inflation environment that we saw in the 70s, and that is that people who could live through that crisis, who had the ability, had fixed rate debt, or the ability to hold on, when rates settled down, their rents were at a much higher level than before, and there was a huge wealth creation occurring in real estate. However, it's not so easy to get to the other side when the bank is calling and you can't afford to pay your debt service. And so I think we're going to have a tremendous amount of volatility kind of coming through this period. And what's I think very different than before is we had an environment where there was a need for all asset classes and a growing economy. Even though we have a growing economy, it's not clear what demand for every asset class is going to be. And so that's a very different backdrop to come through this volatility. And so I think that we're going to see people who can hold on to the best properties see rents really increase through this period and get the benefit of inflation if they can hold on to the asset. And we're going to need to see major restructuring in other assets, which really aren't going to meet the needs of the economy right now. And in an environment where those rents are going down, I think it's, we're going to see real destruction of value.
Thank you. Question for team. These days, everyone, all of us are requesting where the market is in terms of spread. And we can basically say where the market for AAA is, for a senior. And then we've been asking, where are cap rates? And some of the argument you hear is, okay, the price is not reset yet, the property market price. So what you think is, when this market is going to reset, what do you think is going to be, what are going to be the drivers for this market to reset?
I think some of it does come back to interest rate volatility and the ability for owners of real estate to really get a sense of what long-term borrowing costs are going to be able to really model that out and think about what the appropriate valuations are. And I'm sure there will be a bifurcation like there has been over the past number of years. Inflation, as was discussed, is not a bad thing for real estate, but it's a particularly good thing for real estate that has shorter duration cash flows where you can capture rent growth in the short term and then hold on to that over the longer term. And so I think that'll be a differentiator in terms of where cap rates settle out for different asset classes, because some are going to continue to see a lot of growth and others are going to be a bit more challenged. The other thing to factor in to all of this is that supply is dropping off very quickly as a result of higher interest rates, overall volatility, higher costs of construction. And as a long-term fundamental, that's really the most important one to keep in mind for real estate. So I think as was discussed earlier, getting through this period of time is really important in making sure that you have a stable capital structure, because there are actually really positive opportunities to capture in this environment.
But picking up on what you said and what actually Jeff said before, can we can we think about the refi wall, in particular the floating rate loans coming in 2023 to be the catalyst for, forcing the market, the real estate market to reprice? Because at the end of the day, we discussed later, there's going to be a gap, the famous gap, funding gap, that will generate, the necessity for actions. So is this the moment we're expecting where, the real estate will need to reprice, or is we will have a slow, move into a different cycle? What's your view?
I think it's certainly gonna force the issue and cause some price transparency earlier than maybe folks would otherwise want to have happen, and that's a material difference between this and what we went through in 2020. That was a sharp decline and sharp recovery with very low rates to help everybody along the way, and the pressure that this puts on the overall structure and borrowers, particularly borrowers that had tight cash flow coverage to begin with, that pressure is going to build. And I think what it comes down to at the end of the day is, are your assets performing well or not? And if your assets are performing well, even with an increased cost of capital, I think more likely than not, people are going to stick with those assets to get to the other side. If your asset performance is struggling, that's going to be a harder story, and that's going to force more issues into the market more quickly.
I would say the public markets are already telling you that asset values are down. And it is usual that the public markets overreact, and maybe that means that real estate securities are the best opportunity out there right at this moment. But the private market is kind of holding on, and the public market is telling you, don't hold on, it's all crashing down from a valuation perspective. And usually things shake out someplace in between, and kind of waiting for that environment or waiting for the opportunities to shake out is kind of where we're sitting right now.
I mean, ultimately, I think you need a volume of voluntary sales. Sure, the 2024, 2023 wall of maturities will happen, but I mean, we've been transacting in this past year, and people will put to comps, point to the comps and prices we've transacted, and they'll point to it and say that was a distressed idiosyncratic sell, that was a forced sell, it's not a true market comparison. I think in the reality to get people off the sidelines is you need rate stability, right? I think when you look at this past year, you've had 100 bip moves in the 10-year and 50 bips to no bid on credit spreads intra-quarter. And I think if you're a levered real estate investor, investing in this environment where you don't know what your risk-free rate and you don't know what your credit spread rate is like playing chess, but the pieces are made out of smoke and the board's made out of water. Yep. It's impossible, right? So I think if we can go into 23 and see 3 quarters of tighter range-bound rates, I think people will have more comfort sticking things in a model, and I think there's a ton of dry powder raised to start being more offensive.
The first stage of grief is low volume, and that's people in shock and not really willing to trade. Seller, I'm not going to sell low. Buyer, I'm going to wait on the sideline. I think the second stage is going to be banks getting the keys back or restructuring or trying to work out paths in mortgages that roll, and then we can start talking about value. But the reality is, if your cash flow is the same as it was in 2019, you can't afford the mortgage that you took in 2019, period, hard stop. Rates are significantly too high. So you're going to have to find capital. You're going to have to find capital to buy a new rate cap, really expensive. And this is a really difficult feeling out period. If rates just hold here and you're hundreds of basis points wider, I think just generically every commercial real estate asset's worth 15 or 20% less bare baseline if it's rolling, and then go up from there.
Let me just give something, understand, you're expecting a tough 2023 in front of us. I agree with you. How do you, similar to what I asked Miriam before, how do you prepare? What have you done so far? How do you prepare your organization for this 2023?
Yeah, listen, sorry, he was looking at me, but
No,
why don't
go
you
ahead.
answer?
Go
Because
ahead.
I've spoken too much.
Sure, so I would say a couple things. One, I think your point around the floating rate debt is a really good one. If you look at issuance over the last couple of years, 70% of it has been floating rate, if you include the CLO market. And I think the market is vastly underhedged. So typically borrowers were only buying caps for 2 years when they had a 5-year loan. And the cost of that cap is now 40 times what it was at the beginning of the year. So dramatically higher. I think what we're focused on is a couple things. One, we've re-underwritten our entire office portfolio. So having a view going in both our direct balance sheet and our warehouse around where we think values are. But I think the most important thing is going to be that choice that borrowers need to make in terms of whether or not they're going to feed assets. And if borrowers want to feed assets and buy the new rate cap, support negative carry and that sort of thing, then we want to work with them. and figure out a solution. But I think it's a much harder choice this time around for folks versus the last 10 years when basically you had the benefit of incredibly low rates and you didn't have to come out of pocket every month. And so I think it's very much going to have to be sort of a collaborative period where borrowers are going to have to decide if they're going to feed assets, and if so, I think their lenders will be helpful. But I suspect that there are going to be a lot of situations where it just doesn't make sense, and in that situation, lenders are going to have to deal with potentially getting the keys back.
So big the underwriting exercise, focus on offices, focus on ICR coverage. There's going to be the way to get
and I think
here.
getting ahead of it early, so you don't want to wait until a loan is maturing. You want to have that conversation, 6, 12 months before to understand where both sides stand.
Let's shift a little bit the topic and focus on the liquidity, in particular liquidity going forward. Jesse, last year, you and I, but one of the topics we discussed was this huge amount or wave of cash, money coming into real estate. This year we're seeing, obviously this pace has reduced, and we see some redemption. It's been on the news. Let's talk about the liquidity. This redemption of people getting out of the industry is more managing general liquidity, or is a sign of reduced appetite for the asset class?
Yeah, listen, I was dead wrong last year and probably the year before and probably 100 times in between, but I was dead wrong because there were 240 billion or maybe 245 billion last year, and it's still around 220 billion of private equity money on the sidelines ready to invest in commercial real estate. And that's lovely, except for private equity uses floating rate debt, and floating rate debt is really expensive. So all of that money that is saved up, that is willing to be deployed today, and that's $1 trillion of buying power, simply isn't going to buy at today's interest rate. So I thought of it as a put for the real estate market. I was completely wrong that if rates go up and spreads widen along with it, that bid is gone because financing is too expensive. So I think there are people willing to do things on the margin. I think you'll see a lot of equity come into conversions of B office to things like multi or some other obsolete assets. But I don't think that people are sort of chasing a 4-cap multi anymore, or chasing a 5.5 cap office. Like, great tenancy, I need to own it, because the cost of financing is so high. So I don't think any amount of equity on the sidelines bails this market out until the rate side normalizes.
And I think the equity that's on the sidelines is largely opportunistic. So a lot of the core money from the Odyssey funds, from the NTRs that were able to buy things at very tight cap rates, all of that is kind of going the other way. There are a lot of redemptions across both of those. And so the dollars that are out there are targeting double-digit returns for the most part. And so I think that's also going to have an impact on property values.
I will say that in multifamily, for example, where you have a more functional financing market with the combination of the agencies, life insurance companies, and you have a very diversified set of investors that invest in that asset class, we're actually seeing pretty good liquidity to sell multifamily, like better than maybe we would have expected in this current environment. So I think there's a big connection between financing availability and liquidity. That's obvious, but also I think the diversification of that asset class in terms of the underlying owners also helps, because to what Miriam said, you can't be relying on just one source of capital that's a higher leverage floating rate borrower necessarily. That could be some of your potential buyer universe, but there's a wide variety of other buyers out there, lower leverage, who look to borrow fixed rate, for example. We're talking a lot about floating rate. It's interesting, fixed rate's becoming pretty attractive on a relative basis. Nobody likes the idea that the 10-year treasury is in the mid threes right now, but there's also been a process of kind of living with that, learning to live with that. It's not the first time in any of our careers that it's been 3.5%, and spreads are actually tighter in fixed rate. There's more appetite from a broader base of end credit investors for fixed rate product, and so as a result, if you want to buy a multifamily asset today, you can borrow at 3.5% 10-year treasury and a 200 basis point credit spread and a 5.5% cost of debt. Not horrible, and so it actually creates a little bit of a functional market. So I think they're kind of tied together, the liquidity and the real estate credit markets to the overall capital markets.
Richard, going back on the point of this news about redemption, is something concerning you? Is normal dynamic, people working their liquidity? What is your take on this?
Think about this. People walk out of their office with their laptop, and they've taken their whole office with them. We've had tremendous expansion of bandwidth to every corner of the United States. And that's tremendously disruptive. And that all really happened before COVID. And now I think we're trying to figure out kind of what that means for every asset class that we have. Do residential units need to be bigger? How much co-working space do you need to program into a residential building? What does this all mean clearly for office? I don't really think we need to get into too much of that. And then how does that impact demand for goods? We've got onshoring. All these things are really kind of changing the landscape. And we have to also remember that every region in the US is experiencing things different. There are parts of the US, specifically in the Southwest, that are really benefiting from all these changes, both from a lifestyle perspective and because we're seeing industry onshore. And so we were living through a change in the world with COVID. We went and decided to stimulate, create inflation, and then a war came, and you've now got supply chain disruption. So all of these disruptions have a knock-on impact on how we consume real estate, how we live, where we live, and I think we're just at the beginning of it. To be very specific, I think places like New York have to think about how do we get people into the office, how do we create more collaborative economy, research-based, where people need to be together. And the final thing to just say on that is there are a lot of markets that are significantly dependent on tax revenue from assets that may or may not be obsolete, and that could create a vicious cycle in many regards.
I mean, Thanks. The office market, let's call it what it is. It's in trouble, right? You have 2.5 years now since the beginning of COVID.
I was trying to be nice. Come on.
I'm trying to be honest.
I want to come back later on office market, but if you want to discuss about offices, let's go.
You have 2.5 years since COVID, so anybody who signed a 5-year lease, only half of them had a second bite of the apple. You're 20%-ish vacancy in every major metro. I don't see it being below 20 at the end of this 5 years, when everyone gets the full bite of the apple for the reasons Richard said. We have our computer and we can go somewhere else. A office is fantastic. We all are fortunate that we work at companies where we can afford a office space. We want to drive people back. So we'll spend $150 to be in One Vanderbilt, or $200 to be in One Vanderbilt or Hudson Yards and get people back. But in a B office, what's the attraction? And then you throw in the fact that TIs are way more than they used to be, that free rent is more than it used to be, that the building feels old, and the net effect of rents just don't cover the mortgages that we thought were reasonable mortgages on the 40s and Lex or Third going back. And we have to completely rethink that, because there's no interest rate really that bails that trade out. So the office market in a lot of these big cities is going to have a long time to sort of figure itself out. Fortunately, most of us up here have lent on A office and avoided B office for a long time, because we've had sort of theories about that and how it might play out. But if you have a big B office portfolio in any city, I think it's going to be a really hard 5 or 10 years.
Given you open the conversation about offices, at the end of the day, we grew up in a market where offices were the most important food group as size of the market. Now we understand, for a few years we've been discussing about flights to quality, A versus B conversion, but now it seems that there is no appetite at all for offices. So what is the future, in particular in the capital markets for offices? How these loans are going to get refi if the market goes like this?
I think one of the problems is that everybody already has too much office. So I think we all believe that there's a real difference between Class A and Class B, and that Class A has a reason to be here. We probably all go to the office every day, up here on the stage. But I think one of the challenges, especially if you're at a bank, is that there's a regulatory overlay as well, where regulators are very focused on office, on hotel, and on non-income producing real estate. And so if you look at your portfolio, even if you've really focused on the good stuff over the last couple of years, you already probably have a little more than you want. And so then the idea for a lot of banks of going to their credit officer and saying, hey, I'm adding more, don't worry, this one is different, it's better, by the time you get to the third sentence, they want you out of the room.
You're going to get a skin reaction, yeah.
Exactly. And so I think a lot of investors are just saying life is too short. That said, I do think it's an incredible opportunity if you have the right capital. I think that One Vanderbilts of the world are always going to be here. People have a reason to go there. And to the extent that you can get paid historically high rates to finance the best stuff, that's pretty attractive, but I think having the right capital is a challenge.
Well, it's not clear to me, and this is because there's been very few transactions on a office, that you can get paid well enough. In our portfolio, for example, we have 0 retail. Now, maybe that was a mistake as we've seen retail come back, but our thought was very simply, on the good retail, you couldn't get paid enough. And on the bad retail, there was no price that was enough. All right? And I think when I'm looking at office, I'm starting to see that. And maybe the capital markets are going to reward people who can lean into A office. But right now, I think the spreads on A office stuff that I've seen, especially in kind of high growth locations, has not been super compelling relative to other opportunities out there.
I mean, sentiment is so bad for office right now. It's worse than anything I've heard of in my career. I wasn't working in 9/11, but my understanding about hotel fundamentals then is no one wanted to touch a hotel for a year. It has all the telltale signs of an interesting contrarian play. I think for us, we have bought into the thesis of high quality trophy office. We've participated in opportunistic lending in that space this year. We've participated in buying office for conversion to multifamily. So the tails, I think we're in. The hefty middle, there is going to be a level where if you're a well-capitalized sponsor buying at an attractive basis, you can buy market share. And
it's an important point. What's actually for you, what does need to have a deal for you to be attractive today, an office deal, to engage? What are the...
So the problem is when you look at the REIT space, everything's for sale. Sure, office REITs are getting crushed, but so are multifamily REITs, so are strip retail REITs, so is everything else that has a tighter cone of outcomes, right? So at a level, we will be going back into the office space. I think the problem is with the opportunity set, it's a really hard way to make a buck. And from a risk return perspective, it has more risk than return on where sellers' expectations are. So I just think it's going to work itself out, but there will find equilibrium. I think you just need to be pretty prudent at the moment, and I think everything else other than office needs to tighten first.
Tim, you obviously a huge origination platform over there. What does need to have someone to come to you and get your attention on office loan these days?
I do think it's all about just the fundamentals within the asset itself. I think we want to lend against something that has the prospects of leasing in the relative near term and being able to achieve at this point in time a pretty high stabilized debt yield. I don't think any of us want to take a risk on precisely what the cap rate is going to be at the end of the day. So we want to have a lot of cushion for where we can get to. So I think it comes down to demand. And as everybody said up here, what we have seen in the fundamentals is that the high quality assets are pretty irreplaceable. Like I said before, we're not going to see new buildings built for a while, given the high cost to build and this negative sentiment. So the assets that are newer vintage and well located are going to have a good amount of demand, which I think would be good. The challenge for office is it's gotten hit from every single angle. I do generally agree with what Jesse said, and we haven't even talked about the fact that office is not great in a recession, which is probably where we're headed. So the near term and medium term prospects, I think, as we've all discussed here, it just seems easier to invest in other places, and right now it still feels pretty hard because you don't have the fundamentals you want to see. There's I think a feeling that the growth of people coming back to there will be growth in people coming back to the office, but how much and in what locations and how that plays out is still relatively unknown. And you have high rates and a looming potential for an economic slowdown next year. And all of that together is just kind of like why would you want to jump in right now?
The problem is the four of us as transitional lenders, if we wanted to make a bet on office today, we really can't because Miriam and her peers are gatekeepers of that. We brought our office exposure from about 40% of our book to about 20% of our book since the beginning of COVID. We've strategically tried to do that, so it would seem like if you're going to be opportunistic, now's the time. But I can't borrow. AAA CLO paper, we just had a AAA CLO, not ours, go off in the market at 325 over for AAAs, and it was mostly multifamily. If it was mostly office, it would have been closer to 400 over for the AAAs. And
Probably wouldn't have gotten done.
And probably wouldn't have gotten done,
Yep.
That's correct. But just teasing it out, that's sort of mid 8% AAAs. There's not enough room unless somebody has tremendous cash flow that came from, somewhere, there's a vault of gold in the basement. There's never going to be enough cash flow to cover that kind of spread above today's base rate. And the banks are simply saying no to us because they're following where the CLO market's going. And if we can borrow in the 200s over in multis, we're going to be borrowing in the high 300s over from them. So we have to lend in the high 400s to 500 over to make money on anything transitional. We can't make a bet because it's too expensive for us to make a bet because the bank's out there. So until the credit officers change their mind, office can't dig out.
Let's go back to the capital markets in 2 seconds with Miriam. We touch base on this a little bit. Tons of liquidity to the real estate market comes from CMBS. The peak of the market before GFC, I think it was without excluding the agency business. The banking were producing in the region of $200 billion of CMBS bond per year. The market reduced in terms of size, but last year, these days, we could not keep up with the demand. This year, I think we're talking about a $7 billion of CMBS issued in a quarter. So the market is basically down to what do you expect is going to be, what are the perspectives of this market getting to 2023? Floating versus fixed. Is 5 years fixed the solution for bringing back, borrowers and bond buyers to the same table? What's your expectations? What are your expectations?
So a lot of unknowns and hard to predict volume, but I think that 23 could actually end up kind of similar to 22 from a total volume perspective. We do think that the 5-year fixed rate product solves a lot of issues. One, we found that bond buyers really want to be shorter duration. So buying 10-year paper in this market, I think, is just challenging, particularly if you look at the curve. And then I think for borrowers as well, having certainty for the next 5 years around exactly what your coupon is going to be, not having to buy caps every couple of years after the initial maturity, that's powerful from a cost perspective. And then I think we've always seen historically real estate owners like to hope too. So rather than locking in 8% for 10 years, you're only locking in a higher coupon for 5. So I think the 5-year product should certainly have some legs. Now I think the challenge is that so far we're finding mostly office and retail for 5-year. We need to figure out how to get multi and industrial and self-storage.
To get the pool together.
Some of the other asset classes that people like, but that's a product we're really excited about. And then I also think, to the point earlier, if you think about the number of deals where people actually would like to refi early, take some risk off the table. If you think about the backlog in the CLO market where people would like to get off of their mark-to-market financing and put term non-mark-to-market financing on, I think if you do see some stability, that number could actually be much larger. I also think if you start to see some more transactions of large scale, CMBS really is historically the way that a lot of that gets financed. It's very hard to do a bank syndicate and get 10 different banks to show up at the same time. And so people really do value the CMBS market when it's there, but it's been wider and there hasn't been a lot of transaction activity. And so that has depressed issuance for sure in the second half.
Just let me ask you something. Obviously, the CMBS, the capital markets will have, some challenging, time in front of us. Definitely is, for everything we discussed, there is the need to finance a gap between where the leverage is today, where the leverage could be tomorrow. Where do you think this liquidity will come from? How much liquidity or dry powder is still in the sovereign funds? And there is a risk appetite there to increase the exposure to real estate. Jesse.
I mean, good news and bad news, right? If I can write a 60% mortgage at an 8 to 10% return today, 2 things are going to happen. And the supply-demand of capital technicals is going to solve itself, right? There's going to be no transaction volume because no equity returns make sense there. And there's going to be a ton of private debt capital. I think there's going to be a real supply capital response in fundraising for investors that think this will be an attractive relative return. I know we've been super active in the past year in credit. We'll continue to be so in the next couple of years. How to handicap that? I know it's tens of billions of dollars. Is it 20 billion? Is it 100 billion? It's hard to say. The bad news is the fundraising takes a long time. The vehicles have to ramp. And the cost of the debt is going to be more expensive than what borrowers are accustomed to. So it's not going to be a salve. It's going to be liquidity, right? It's going to be, a bridge to the exit. But, I think that we're going to be living in an environment of heightened borrowing costs for, a reasonable amount of time here.
Richard, what do you think about liquidity? Where do you think the gap money is going to come? Is it going to be equity money raised at certain levels that will redeploy this debt? What do you think is going to be the...
Well, I think the CMBS market coming back is certainly crucial. But I also think we need to see the bank bid back in the market. The reason that you can make that 60% transitional loan at 8 to 10% is that there's very little back leverage in the system. And so we need to see the banks step back into the market. And I think that's going to take some time. And in the interim, people like many of us on this panel are going to be able to get kind of unusual size risk-adjusted returns, not necessarily the best absolute returns we've ever seen, but to be quite frank, you can make a 55, 60% loan at close to 10%. I've never seen that in my career, right? And nature abhors a vacuum, and so I think, there'll be some capital formation. We'll have a year or so where people will make these outsized returns doing this. And then I think we'll see the banks come back in. It just makes too much sense. They're the low-cost provider of capital. They have the lowest return requirements, but they are sitting on their hands. And so it's really a question of what the banks will do. I think it's also important to recognize that much of why the alternative lender segment exists is because we had regulation in the form of Dodd-Frank, right? And that created the opportunity. And so now banks are trying to figure out, what do I do in this crisis environment relative to this newly and highly regulated system that I'm engaged in. And I think it's just going to take time to work out, but eventually I do think the banks come back. But it probably takes a year, maybe 2 years.
Yeah, but for the same reason, I think we're in this place, and it's that quantitative tapering got announced in February, and they stopped buying mortgages. And to me, that led to all the spread widening. Every spread buyer moved over, bought agency mortgages that allowed all of our spreads to move wider. It's why we're at 325 over. So the government started it, but ultimately the government's putting a hammer in it, not by raising rates, but by putting recessionary overlays in their CECL reserve calcs. And so we're all getting hit with new overlays, and they do include recessions, and they are not positive for office. And so you have to have more capital if you're sitting at a bank. So we can hope the banks come back in, but until the CECL reserve numbers start to go the other way, and they can free up more capital, the banks will be more stingy, and that will force us to be more stingy. So I think it's really in the government's hands. If they want to continue to see office suffer, they can continue to ramp up and they have every right to do it, because I don't think they're wrong, ramp up their recessionary forecasts, but the bank's going to have to hold more capital, and that will slow the wheels even further.
Yeah, I think there are a couple of things happening with banks. One, the banks are relatively full. So if you look at the first half of the year, banks dramatically increased their commercial real estate exposure, and part of that was what happened in the CMBS market. Yep. So people have backlogs of paper that they need to sell. And then I think this regulatory framework is a really important point. We're seeing the regulators take a pretty punitive view of commercial real estate in the stress tests and other sort of models that they run for banks. And so I think as banks focus on getting ready for a potential recession, focus on their capital ratios, reducing commercial real estate is one way to do that. And then the last point I would make there is that in the last 10 years, the regulators have also sort of changed the capital treatment for indirect real estate and direct real estate, meaning that if we do warehouse lending, where we're providing loan on loan, that gets much better capital treatment than making a direct loan. So I think you've also seen banks sort of migrate to that business away from direct lending as well. The other thing we're seeing...
We like that.
Yeah, no,
less competition and
exactly.
lower
Let's talk about this.
Yeah. I think the banks that are active are very focused on a credit box that is pretty prescriptive in terms of you need an 8 debt yield, you need a certain DSCR, and they'd much rather buy a new originated loan that really checks all those boxes versus buy something cheap. So there's not a lot of competition for you guys there.
Look, but I do think greed will come into this at some point. The capital markets are such that these returns aren't going to last forever. And whether it is people buying things off of the banks' balance sheets at returns that we haven't seen before, or just going into the bond market and buying CMBS at discounts, those are the type of things that those returns, when people start to see those returns as being unsustainable, more capital will accumulate and things will change. But it's going to take time for all the reasons you guys are stating.
Just sticking to you, New Yorker, real estate guy, going back to the office discussion we had before, you read somehow that, construction is basically being obviously reducing activity. There's no greater volume of new supply coming. We will help out the market, but still people talking about, 10-15% of oversupply office space in the city, which is, if you turn it in numbers, you're talking about, 75 to 90, million square feet of office that, need to be repositioned. What's the future of this? How do you reposition all this space? It's a huge space. I understand the city has unlimited resources, but what do you expect to happen?
Yeah, so when we include sublease space, some figures are that we've got 20 to 25% vacancy. So it's really maybe 30. I mean, it's bad. And then utilization rates, 40, 50%, real bad. So what does that mean? I think that means that we need to think about public policy a little bit here. There are really, we've had this tremendous movement of young people back to New York post-pandemic. But guess what? That's great for multifamily, but they're not going into the office. 40% of jobs on LinkedIn with New York locations allow you, and this was 3 months ago, maybe it's changed, allow you to work remotely 100%. So this is a very strange dynamic. And so I think what we have to think about as a city is, how do we create the environments, the 24-hour environments, where people are willing to live and work and go into the office and create more vibrancy? And we've got vast swaths of areas in New York that are just zoned office, just zoned commercial. So we got to think about rezoning. We think about incentives for people to commute into the city, and perhaps create more density for people if they're building mixed use. We just really need to kind of I think we need to rethink how we view our neighborhoods, and that's going to be a tough process. But I do think at least this administration is willing to listen, but it's not going to be easy, and we have to try to fight for companies to come here, right? So everyone's offering tax incentives every other state. We've got to fight for those collaborative jobs, those research jobs, to be here, and this is a really gigantic challenge for New York City to rethink about itself.
Gotcha.
As a Miami resident, I can say it's very hard for New York to win that battle.
Yeah.
Mean so?
There are a lot of other easier places to live. I think you need to be competitive on price.
Tell me something. I'm going to ask you something now. Obviously, the pickup of activity in the office space, in particular in Florida, has been in front of everybody. Okay, and we see other cities that are struggling. Some CBDs are basically difficult to find tenants. It's just a matter of sunshine, just a matter of taxes, or why the market in Chicago is is so different from what's going on in Miami. What is just a matter of taxes, or is it something else?
Yeah, listen, I think it's everything. I think it's lifestyle. I think COVID gave people an opportunity to live somewhere and work remotely, even in jobs like ours, for a minute, and people realized that it was nice to not be stuck in New York City. I came here this morning, it's cold and in the 40s, and that's kind of how I think in my mind New York is the whole winter for 7 months, and I can't understand why anybody would want to be here.
I find it very romantic.
But to a lot of you guys, you're probably like, hey, it's not in the 30s, this is a great day. But when you've had the perspective for a couple of years, and I think COVID helped drive that you don't have to live in New York, and I think absent COVID, we probably wouldn't have felt that way. I think think that sunny, lower tax states are going to continue to do better.
I think that, Miami to me is gets a lot of the headlines, but I think that Dallas is a much more like compelling example of why not Chicago. People move from Chicago to Dallas and places like that mainly because it does offer a more affordable cost of living. Miami's pretty expensive overall. It's got a smaller office market, smaller underlying employment base, and you're just seeing growth in these areas where there is a good quality of life, there is a lower cost advantage, and there is very favorable economic stimulus to come into the state. I mean, there's it's not hard math to figure out, and I think Dallas is one of those places that's really created a real underlying economic engine that's just become attractive on a standalone basis, even when you take a lot of that incentive out of it and you just look straight up at the underlying workforce, the housing options, all of that. It's just a more attractive place overall for a corporate to think about locating.
Let me ask you directly, how much do you think criminality rates are affecting investment decisions? It's just headlines, or people basically decide to relocate also for a matter of quality of life? And this is actually why certain markets are getting doing better than others.
I think
I know it's a tough question, and I don't want to get political, but
it'll be a little interesting to see over the next couple of years. We're going into a different economic. We've just lived through an environment where the employee had all of the leverage and everything, and so the employer had to think about how to keep the employee happy in a way that it almost never has had to do. And we're heading into a bit of a different environment where that's likely to shift back more toward normal. I think the decisions ultimately end up being about economics, about the culture that you want to create, about the talent that you're trying to hire, and where those things are. Because successful companies need those things more than they need to necessarily satisfy a certain percentage of days in the sunshine a year. But it happens to be the case that a lot of those growth areas in the Sun Belt have just become really, really attractive engines on their own, and I think that can continue to stand up in this environment.
I mean, we discussed about a lot about offices, for a reason. The asset class which was under scrutiny during COVID was hospitality. Where are we in hospitality? Jesse, are your hospitality book performing? What's your appetite for hospitality? Is resort versus business destination? What is the view for the next year?
I think we're in the season where we all just booked our Christmas vacations and spring breaks. So, depending on the cost of those, I think everyone's probably big believers in hospitality fundamentals going forward. Listen, continued increase in travel trends, continued increase in consumer wallet share. We think this is like a secular story for hotels. I think the problematic thing is, you're sitting at peak on peak fundamentals and ADRs and staring in the face of a recession. So I think from a valuation perspective, it's really hard to get exposure, but we really like hospitality, and it's something we want to continue to find opportunities in.
I think also the slightly wider cap rates are helpful in this higher rate environment where you don't necessarily have the same coverage issues that you do on 3-cap multi.
Yeah. And debt yields are off the charts, right? And so as we look at CLO reinvestment, it's very hard to get enough debt service coverage for CLO reinvestment assets. This makes a lot of sense to us. The hardest thing about lending on hotels, and I think we all see what's happening in revenue. Like our one hotel in Miami, we're averaging over $1,000 a night in the winter. It's insane. Here, it's over $1,000 for this period. But the hard thing is the banks aren't lending to us. They're lending to us similar to how they would lend to us on retail. Yeah. Because 2020 just happened and 2021 just happened, and it took a minute, and it's going to take a minute to get out of their minds. So I think we're very open to lending there, but it's not a preferred lending spot for CLOs or for banks. So
with a few minutes left, I want to ask you a general question about the end of a cycle, which we probably get into. It's probably the right time to think about is the industry require some modernization? I mean, do you think actually there is a need for some radical changes in our industry? Digitalization. We don't have a property index. What's your view about how the industry can basically get in the new cycle? Any significant change of the game rules that we should probably think about? Which you want to start?
Sure. We think about kind of digitizing real estate. I think one of the first things we have to recognize is that a lot of the digital solutions are expensive to implement and don't actually improve things all that much. And every week there's another digital solution that is being thrown at your property management and asset management team. And so it's going to take a while for us to really develop things that are easy to implement and have real direct benefits. And I think once everything that happens at a property, including a renovation or a unit turn, is completely digitized, all bill paying is completely integrated into the system, until we create that kind of digital ecosystem, it's very hard to have great financial innovation around a kind of a token or a kind of more enabled functioning securitization of assets. And I think it'll come. It's going to be slow. Prop tech is probably either overinvested, underadopted, or both. And it's just going to take a long time.
I think first movers in digitization of real estate are going to be scammers, and people are going to lose money, and it's going to be terrible headlines. So it's the second generation where it might actually work. So I think it'll take a while, because we're not going to do it. Blackstone's not going to do it. Starwood's not going to be the first to do it. It's going to be people who have a bad asset that they want to get out of at a bad price, and they're going to scam people, and there'll be headlines forever. I think digitization makes a ton of sense for title. I'm sorry, all the title brokers, but the world probably doesn't need a tax on every real estate transaction if there's a blockchain. So there'll be easy ways that it'll get implemented, but I'm sort of super worried about the digitization of pieces of real estate, because without an SEC or somebody standing over it saying, prove those cash flows to me, without any regulatory body, bad people are going to put people into bad trades. And then we'll be reinventing what the SEC should have done going into that, but there just isn't a big enough SEC to deal with it, and it's going to be a real problem, I think.
Miriam, a lot of, just to close up, a lot of young professional and the students in the room, a piece of advice for people, getting into this challenging 2023. What would you say?
I think picking up on our office discussion, my piece of advice would be go to the office. I think that there is truly, but truly there is no replacement for sitting next to somebody, particularly in these type of environments, and hearing firsthand what's happening. So I would say go to the office. Pick up the phone, walk into somebody's office, don't send an email. I think we kind of have to go back to basics there, and I think particularly in this environment, that will pay a lot of dividends.
So go to the office, Jeff.
It's not a violation of your human rights to get your boss a cup of coffee. Like, learn the way that I learned, and don't...
Back to basic, Jesse.
Lose the wokeness.
I would deprioritize a focus on like day one comp, day one title, remote flexibility. The only important thing is you work for a company that's relevant, that can be active in this market, that has smart people that want to teach you. I think that's
long term
success.
Tim?
Never let it go if there's something that you don't understand. I think it can be easy to just kind of get overwhelmed by the new things you learn in any industry. Real estate's one that has a lot of history to it. It has a lot of acronyms. It has a lot of people's characters, et cetera. If you hear something that you don't understand, look it up, figure it out. I used to use Ask Jeeves. You can probably use a different website at this point in time.
Richard?
Yeah, don't take whatever job is available to you that gets you in the door in real estate. Some of the best lessons that I learned was working in the facilities department, because I was in an investment bank and my whole department got laid off. I went to the facilities department. That was one of the best things I did. So take whatever that job that gets you started in the real estate business.
Perfect. Okay, Doc. I think we're done. Thanks a lot, guys. Thanks, Matt.